Hi, this is Luke Gromen, FFTT. Hope you are well and having a great week. Thanks for joining me. Thank you for the questions. As always, greatly appreciate them. Let's jump right in to make the most of the time. First question is from Gary. Luke, what percentage of the debt market can you see rotating out and entering the gold asset class? It's a tough question to answer because there's a lot of variables. It depends on productivity miracle, whether it arrives, how fast it arrives, if it does arrive. It depends on policy choices. Do policymakers actually let rates rise to levels that force the U.S. government to slash defense and entitlements? Unlikely. Or do they keep intervening with dollar liquidity every time the Treasury market dysfunctions because rates are getting too high or global balance sheet is insufficient relative to the size of U.S. deficits? That's much more likely. And how do they pace those actions? What's the path to those actions? Directionally, here's how I keep boiling it down. Western sovereign debt broadly, U.S. debt, government debt specifically, it's not sustainable unless you have negative real interest rates, unless interest rates are below the rate of inflation. The global sovereign debt-backed monetary system is also at the same time fundamentally incompatible with the productivity miracle we need to get us out of the debt problem. You get tech deflation, it arrives too fast, unemployment goes up, that creates the same debt crisis. So we're caught between two pincers that are squeezing down, and to be blunt, I'm not trying to trade it with my money. I can see this happening. I don't need to get the timing exactly right. I just need to be unlevered so that I can last longer. And I think, not what I think, who cares what I think, what we are seeing play out in the markets, in the charts that we're highlighting for people, the $130 trillion bond market is squeezing into $65 trillion equity market, the $14 trillion gold market, and the $1.4 trillion Bitcoin market. I own T-bills. I think owning short-term government paper is fine, but in my opinion, mid to long-term Western sovereign bonds more broadly, I think they will continue to underperform these asset classes, these harder asset classes that will do better in a secularly inflationary environment. And I think within that, I think stocks have been and will continue to underperform gold and Bitcoin this cycle. We can see since late 19 that stocks have been basically flat to down slightly versus gold, and obviously down quite a bit versus Bitcoin. Next question from Chris. The gold to grams oil ratio has now reached 1. So 1 gram of gold per 1 gram of gold per barrel of oil. Historically, its historical limit. Given OPEC's recent decision to phase in more production, does this signal their willingness to push that ratio lower, perhaps to the 0.5 mark that Pozar and Glaziev have highlighted in the past? Could this be a new paradigm, etc.? In my opinion, yes. Multi-currency oil pricing with net gold settlement, a symptom of that being pushed forward would be OPEC running production higher. You would do that because you want to get the better currency, gold, with more cheaply before it's revalued higher by oil. In other words, OPEC Plus would run oil production full out in a multi-currency system net settled by gold. Because remember, the oil market's 12 to 15 times bigger than the gold market in annual physical production terms. So you only need a cartel to manage prices like OPEC when you are selling a commodity in a single fiat currency. When you're selling oil for gold effectively, which is what I'm saying here, you can run full out. Your incentives are to run full out. It's actually it's great for consumers. Oil prices, in theory, should drop relative to gold. They wouldn't necessarily drop relative to dollars. Therein lies the rub. So my view is the gold-oil ratio is going to continue to rise over time. It's up 4x from 8 to 32 barrels per ounce since Putin started buying gold in '08. I think it's going to continue over time for years to come. From Cheryl, do you think it's true that Saudi Arabia will stop pricing oil in dollars and instead be priced in bricks or some other currency? If so, how do you see this playing out in the markets? No, I don't think they're going to stop buying or pricing oil in dollars. I will say I was told 5 to 6 years ago by someone in a position to know that, quote, Saudi will ultimately do what they must to keep their biggest customer happy. Their biggest customer is China, especially post-US shale. I do not think Saudi will stop pricing oil in dollars. I do think they will price oil in other currencies over time and swap whatever currencies they're getting for goods from the country of that currency. And you can see Chinese-Saudi trade has exploded in the last 5 years. And then I think they'll net settle any amount in gold. So we'll see the gold to oil ratio continue to rise. It's great for gold over time. As I noted before, oil's 12 to 15 times bigger than gold annually in physical production terms. It's great for non-dollar commodity demand. If you can print local currency for oil, settle with net goods, and then net settle with gold, you're going to demand a lot more energy, a lot more commodities. So you should see oil and other commodity volumes rise in terms of demand from the global south, broadly speaking. Particularly India and China to start, where there's 2.8 billion people between the two countries. That ultimately is why Saudi would do this, in my view, is they need more demand over time. And if you start pricing in other currencies, net settling in gold, you're going to get a lot more demand in terms of oil from the global south. Now that your demand from your traditional Western customers is flattening out and the Americans are taking some of your market share. Ultimately, what this means for markets is it begins to shift global currencies back to trading more on balance of payments. For the last 30, 40 years, almost everybody on Wall Street has only focused on relative interest rates for currencies, but there's always been a second component. It just hasn't mattered in 40 to 50, maybe 60 years, and that is balance of payments. On a balance of payments basis, the dollar is by far the dirtiest dirty shirt. However, as we transition from the rates-driven FX market world to the balance of payments-driven world I'm describing, paradoxically, you're going to see upward pressure on the dollar, which causes treasury market dysfunction at ever shorter intervals, which forces Fed and Treasury to intervene by injecting more dollar liquidity at ever shorter intervals, driving stocks up, inflation up, gold up, Bitcoin up relative to Treasury bonds and relative to the dollar. Ultimately, on the other side of this, on a balance of payments basis, you'll see the dollar weaken against things like the yen, like the yuan in particular. But that's how I see it playing out both short and longer term. From Ross, if you were the CEO of the United States, what would you do to put us on a sustainable financial path? Ultimately, what we're talking about here is a restructuring situation. So there's a number of ways you could theoretically accomplish that. You need to get debt to GDP down to sustainable levels where the Fed can resume being independent from Treasury and really at any dollar level. And so right now, anytime the dollar gets too strong, the U.S. goes into fiscal dominance. So the Fed and Treasury are not independent. They're independent asterisk. As long as the dollar's low enough, they can be independent. Anytime that dollar gets too strong, that level was 114 on Dixie in the fall of 22. It was 107 last fall 23. It was like 105, 104 last month. So that number's coming down over time. In the meantime, you have to understand as we think about the restructuring, there's only 3 things big enough to cut that matter: entitlements, defense, and interest. That's it. Everything else is a rounding error. You could implement Fed-financed industrial policy that inflates the debt away over, call it 2 to 3 years, and that would crush bondholders on a real basis. Fed's balance sheet probably increases a lot in that scenario. Inflation probably increases a lot. You'd probably need to implement some sort of flat COLA adjustment for Social Security, and then probably ration care for Medicare and Medicaid in that scenario, because healthcare costs are essentially debt off balance sheet in a foreign currency. The Fed nor Treasury can print hips, knees, pharmaceuticals, doctors' time, etc. Uh, Another choice is you could cede Eurasia to the BRICS, cut military spending by $400 to $600 billion a year, bring all the boys and girls home, and refocus our efforts here. I don't think that's going to happen, but that's another possibility. We could also cut rates back to zero and leave them there. Some version of that, I think, is the most likely outcome. Here, too, we have inflation, etc. You could also do other things. You could put, and I'm not advocating this, you asked the question, I'm answering. You could put a 90% death tax on all estates over, say, $50 million or $100 million. No exceptions. And they can track that money. They track that money all over the world. Track it down. If they can get Elliot Spitzer passing a $3,000 check in 2000, I suspect they'd be able to find $90 million of estates around the world on a $100 million estate. So, again, I don't think that's going to happen. I don't think it has a chance of passing. But these are the types of things you could theoretically do. The easiest and the most politically palatable is simply inflation, negative real interest rates on a sustained basis, and I think that's what the outcome is going to be, which again takes us back to point one. Mid and long-term bonds, why? There's no to me, it's just, if you want to trade them, great. But from a secular investment standpoint for the average investor, they don't make a lot of sense to me here. From Don again, if the stock market crashes, isn't it likely that Bitcoin will also crash? I would think, that Bitcoin would see downside, potentially significant. Obviously, it's high volatility over time historically, if the stock market were to quote-unquote crash. I think the variant perception that is absolutely not consensus, but which I am highly confident would happen, is that there'd be pretty significant downside pressure on the treasury market too. Not yields, prices. Rates would rise, in my opinion, in a stock market crash because receipts from stocks, as we've shown, drive marginal consumer spending, which drives marginal GDP, which drives marginal tax receipts. We saw this in 20, 21, 22, 23. Paradoxically, if stocks were to crash and stay down, treasury receipts are going to fall sharply, treasury issuance is going to rise, the dollar will have risen, you'll have net treasury selling going on around the world pretty aggressively, and I think treasury rates would rise in that scenario, which is the Fed's worst nightmare, basically. Stocks down, bonds down. So paradoxically, this also means that the stock market de facto backs the treasury market. We've seen this, like I said, multiple times since 2020, but many market participants still don't believe it yet. Our take on what to do with this knowledge, or how, as we often ask, how do we make money with this? Stocks can still crash. I would never say they can't crash, quote unquote. My view is they will not be allowed to stay down if it happens, for a very simple reason. The U.S. government will not allow itself to be defunded by a stock market crash. And a stock market crash will cause rates to rise on a very indebted government. So you would likely, if you saw a stock market crash, very, very quickly, very large amounts of QE. And nicely, conveniently, empirically, we have a test case with COVID. They came in with, $600 billion a week in QE? Pretty rapidly. So rapidly, in fact, that Warren Buffett said they reacted so fast he didn't have a time to go shopping. With his record cash pile, he couldn't buy anything. The Fed acted too fast. I think it's very instructional. So our view is ultimately that if they're not going to let that be sustained for long, why do we own mid and long-term bonds as an average investor, as a secular investment? Trade, great. But as a secular investment, doesn't make sense. I'd much rather own my duration in the form of gold or Bitcoin. So, and I'd rather own stocks than long-term bonds. So as more market participants do understand this, and I think the understanding is growing, we can see it in the charts in terms of how stocks over long bonds, gold over long bonds, Bitcoin over long bonds are all hockey sticking. I think you'll see that drive further bond market shifts into things like gold, Bitcoin, and stocks. So. From Gail, do you think Yellen is buying as much physical gold as she can under the radar to help buffer the U.S. For a potential run on physical in the future? It seems the U.S. is unlikely to have the purported 8,000 tons today. Purported 8,000 tons. No, I don't think she's buying that much gold. Albert Marco, who's very tied in, asserted a couple of months ago that Treasury's buying some gold on the margin. In my opinion, it would be on the margin to manage markets, to manage the dollar and inflation expectations. I increasingly get the sense that Yellen and much of the U.S. government is really not thinking that much further ahead than either financing the next 12 months or getting to the next episode of Treasury market dysfunction, whichever comes first. From KP, post Great Financial Crisis 2009 to 11, the long bond ETF TLT dipped about 25%, then came back stronger. Are we in a similar dip now since 2020? In my opinion, no. I think it's much more secular this time. Debt to GDP is vastly different, much higher now. Deficit is much higher now at full employment. Net international investment position is much different. It was only negative 15% of GDP then. It's negative 70% of GDP now. Note that from '09 to 11, even after 11, even after they started winding down QE, we really didn't have Treasury market dysfunction post 11 like we have had repeatedly since COVID. And again, to be clear, I'm not saying TLT in the long bond can't rally. It could. It could if you, in the initial stages, if you get a real sharp concern about deflation, like even like what we've had in the last couple of weeks. It tends to trade with oil. So if oil drops sharply like it has in the last week or two, you could see yields come down at the long end. A little bit of a bounce in TLT off the lows from 88 to 92 in the last week or two. I've been keeping an eye on it. If the Fed does yield curve control and they set the cap at 3%, down from 4.35 or wherever the 10-year is today, technically TLT will rally. But you're going to be losing money relative to inflation, losing money relative to gold, losing money relative to Bitcoin, losing money relative to stocks in that scenario. So I just think it's, as one of my best relationships on the street says, long bonds it's blood sport. If you want to go in there and trade and sort of, join Fight Club trying to trade it, it's obviously a prerogative. But I think that the GDP is so high, positive real rates, we know empirically will drive a U.S. debt spiral. We saw it start in 3Q23. For me, given that, I don't think average investors should own instruments that need to fall versus inflation just to keep them nominally money good. That makes no sense to me. I would rather just own gold, Bitcoin, and stocks. That's where I am. That's what I continue to advise. From Ken, any thoughts on stablecoin legislation that will formalize the use of treasuries as collateral? Yeah, it's inflationary. Stablecoins, in my view, are very unlikely going to be buying 30-year treasuries, 10-year treasuries, 7-year treasuries, 5-year treasuries. They're going to be buying T-bills. I don't think they want to take. They're not they're not in the business of being a bank. They don't want to borrow short, lend long. They want to fund long and deploy long. So. You're looking at them putting a lot of money into T-bills. So if stable coins become a more significant way of financing the government, that implies more government financing being done at the front end in T-bills. Reminder, T-bills are just a small step removed from the United States financing itself by the Treasury emitting cash. Cash is just a 0% yielding bond of zero duration. It says Federal Reserve note right on every bill you have, right? Every dollar bill you have, every denomination. A Federal Reserve note, that's a bond. It's just a 0% yielding bond of zero duration. A T-bill is just a 5% yielding bond of whatever that works out to, 3-month duration. I don't know, it's probably slightly less than 3 months, whatever. It's much more cash-like. The more cash-like you are, the more secularly inflationary it is. So, can stablecoins work in terms of creating demand? Absolutely. Is it happening? It does from the little bit I've studied. It looks like it's starting to move in that direction. What does it mean for markets? It's inflationary. It's inflationary, which again, if we're going to finance more and more in T-bills, stablecoins, why do I want to own mid and long-term U.S. treasuries? For what? I'd much rather own gold, Bitcoin, stocks. So those are my thoughts. And then the final question from Andre. Could you please offer a review of your investment thesis for the industrial sector, current status, catalysts? This also ties into the second question I got regarding why I think the U.S. Rust Belt is my favorite emerging market. the U.S. Rust Belt and the U.S. defense industrial base got deindustrialized by the U.S. trade policy with China. So that's reversing. It's unmistakably reversing. And as a side note, you have electrification of vehicles, etc. AI, a lot more electricity is needed, a lot more. That's an additional kicker in terms of demand, electrical infrastructure, equipment, etc. Then you have another kicker, Cold War 2.0. That's providing urgency to do this quickly. Inflation be damned. So it's not going to happen organically. It's going to be given nudges with government industrial policy, regardless of who wins the White House. Biden and Trump are both running on industrial policy platforms. So that's great for industrials. It's great for nominal GDP growth. It's great for inflation over time. It's terrible for the real value of bonds. And if bonds can't serve purpose, gold and Bitcoin will. And we're seeing that in charts. And I think that's still very early days. So at any rate, that will finish up for the day. As always, if you like these updates, please check us out, FFTT-LLC.com, for more information about our Tree Rings product, 10 most interesting things, something that grabbed us about each of those points, made us think differently, or reinforced a way we'd previously been thinking about the world in a stronger way. A lot of great feedback on that, so check it out. And in the meantime, everybody have a great rest of the week. Look forward to chatting with you soon. Take care.